Hello, everyone, and welcome to today's webinar on the purchase or sale of the closely held business. Our presenter for today is Jim Alerding, who I will introduce in a moment. My name is Andy DeZamba, and I'm the executive editor here at BBR. Your attendance here today is eligible for 2 CPE credits. To receive the credits, you must complete and submit a brief survey on today's webinar at the conclusion of our presentation. A link to the survey is included with your registration email, and it's also available on the reading page for today's program. The survey will be active for 5 business days, and it will require you to fill in 3 4-digit CE codes. The codes for today's webinar are 8579, 5213, and 5471. Again, those codes are 8579, 5213, and 5471. I will announce the codes again later during the program. If you have any questions for our presenter, we'll take them in writing only. To do so, please use the chat function on the left side of your screen. If you have any trouble with the audio streaming, please refresh your screen, and that normally fixes the problem. You can also access the webinar with your smartphone or tablet. Well, we're very happy to have our presenter with us back with us today at BBR. Jim Alerding is the owner of Alerding Consulting, LLC, and he consults with business valuation professionals on valuation and litigation projects. During his long career, he performed over 1,000 valuations and testified over 400 times as an expert witness. He's a former member of the AICPA's Business Valuation Committee and is the co-author of SSVS1, now VS100. He's in the AICPA's Business Valuation Hall of Fame, and he is on the editorial advisory board of BBR's Business Valuation Update Monthly. You can read his full bio on the slide deck, and it's also on the webpage for today's webinar. With that, I'll now turn the program over to Jim Alerding. Jim?
Thank you, Andy. I appreciate that. And good morning or afternoon, depending on where you are, for all of you. I'm very happy to be here with this presentation today. Andy was asking me during our prep time here, this is the first time I've done this particular presentation. I've wanted to do it for a while, and this was an opportunity that came up. Purchase or sale of the closely held business is a kind of a passion of mine also. During my career of 40-some years, I was fortunate enough to have participated in a number of purchases and sales of businesses. In other words, often representing the buyer and sometimes representing the seller in a given situation. So I come to this with that background. The materials I'm using today are taken from a portfolio that belongs to the Tax Advisors Planning Series for Thomson Reuters. That portfolio was written by my brother Mike and myself some years ago, and it was updated recently. I updated it a few years ago. So materials are still very pertinent. They're updated, and as you'll see, this is kind of what I like to call the soft side of buying and selling a business. Some of the intangibles that you look at. We won't get into, for example, forecasts or projections. I actually have a separate presentation for that subject. But those are obviously important parts of the buying and selling, but this is going to deal more with the process itself. And the way I've set up the presentation is to split it, not split it evenly, but as you'll see as we go along, I'll start with the buyer's perspective, and then we'll flip to the same subject for the seller's perspective and cover the differences that exist between the two. So I hope that you enjoy that, and we'll just keep moving along here and get into the materials. So this presentation presents some of the issues to consider and how to conduct a purchase or sale, whether you're a buyer or a seller. So let's start with the agenda. You can see we're going to talk about the decision to buy or sell, the preparations necessary for it, determining a price, negotiating and closing the deal. So it's kind of a flow of items here that gets you from the beginning of the process to the end of the process, and then there's a little section on the special considerations for buying and selling also. Okay, learning objectives you can look at yourself. They're follow similar to the agenda. Also, a note that normally I provide as much material as I can on the slides. I don't always cover them all, but they're there for your use, and having attended and purchased this program, you're certainly entitled to make use of the presentation for your own personal use. And so there may be some additional materials in there other than what we may have covered in the actual process today or presentation. So let's start with making the decision. How do I make the decision if I'm going to buy or sell a business? And we'll start out with the buyer's perspective on that. So potential buyers are continually present in large numbers in the marketplace, but qualified potential buyers are less plentiful. So the problems then for a qualified potential buyer start out with selecting the right business. That sounds silly, but it's not really silly at all. It has to be the right business for the right buyer, and there's probably as many mismatches and matches as there are numbers in the universe in that determining that section. There's a great movie, I think it was a 1988 movie, it's called Midnight Express, and it's Charles Grodin and Robert De Niro. And Charles Grodin is an accountant of all things, CPA, and he was a CPA for the mob. And so he had flown the coop on his bail, and Robert De Niro has picked him up and is going to deliver him back to the courtroom for testimony. Long story short, they're on a train going somewhere, and De Niro tells Grodin that he's always wanted to own and operate a restaurant. And Grodin proceeds to try and talk him out of it, and it was particularly humorous to me because it is one of the craziest businesses to try and operate if you don't have a passion for it or you don't know what you're doing. But anyway, so matching the right business covers all the bases. Matching the strengths and resources of the buyer, so to the target companies. And that means you have to have those abilities. I do happen to have a grandson who will be finishing his studies at Purdue University next year in hotel restaurant management, and he wants to operate restaurants. He does want to own restaurants and operate them, and he's perfectly suited for it. So I have no doubt in my mind he will be extremely successful. He's worked in a number of restaurants as internships and just gaining experience. He's just a perfect fit for it, and he has a passion for it. So those are some things that you need to look at as a buyer, or if you're consulting with a buyer, is let's match up the buyer's strengths and resources to the target companies and you have to identify those companies after you've kind of matched up what these strengths and resources are. So finding the sources of potential acquisition candidates, you need to find the right candidates. So the right business is a business that for the most part fits the economic and quality of life goals that the buyer has set for themselves as an owner. It doesn't do you any good to buy a business that's going to provide half the income that the buyer believes that he or she needs to survive in this world, or expects from the assets that they have to invest in the business. So once again, there's just a lot of these factors that play into getting started even in selecting the right business as a buyer. So most buyers are astute enough to recognize the odds of a new business being an immediate answer to their financial problems are small. And it's important. And, it's the same as what I tell people when I talk about valuation issues, that it's oftentimes, if you're representing valuing, for example, a business where the owner may want to sell the business, that there's got to be an expectation in there of what reality is. Well, the same thing is with a buyer of a business. the buyer has to have an expectation of reality. Now, I said I'm not going to cover much on forecasts and all that, but that has to be part of what's put together, is to make sure that the buyer is aware of what might happen when they buy this business. So in selecting the right business, the buyer should establish reasonable, measurable, and attainable goals that reflect personal, business, and financial needs. Sounds easy enough, but you do have to take all 6 of those factors into account in determining what the right business is for a particular buyer. You need to identify and evaluate personal strengths and resources. That's another issue that I think gets missed often, is you'll find some people in the marketplace, they may have some assets, they've always wanted to own a business. And that's as far as they've gotten, is the generic statement of, I really would like to own and operate a business. Well, it's just extremely important that they understand what their strengths and resources are in getting into this whole process of buying a business. So they need to research economic trends in the marketplace. The big one on my mind right now, I'm getting ready to put together an article on artificial intelligence. And AI, 5 years ago, I would have told you I don't think this is going to be a huge impact. I think now that in the next 25 years, it's going to be an enormous impact, and it could run a lot of people out of business. This is not really an AI issue, but it's a good example of what AI could do. I worked with businesses. I helped buy and sell and value a lot of insurance agents, independent insurance agents. Some years ago, it's probably been 25 years ago now, the insurance companies collectively came together and pretty much said to their agents, their independent agents, that you have to automate your process. You can no longer do this paperwork by hand and mail it or fax it or do something like that. You're going to have to get computers, and you're going to have to, here's the software. This company's developed the software. We're all buying into the software as a kind of a uniform way to operate, and you all have to get in there. Well, there were a lot of businesses that didn't make that transition. They weren't able to cope with it, and they went out of business. So it is very important that you know the economic trends in the markets. You know what's going on in the marketplace. I did some research some years ago on seafood markets. Did a presentation on it. And interestingly, there's several factors in there. There's a huge potential shortfall between demand and supply of seafood, the demand being much greater than the supply in the next 20 years. But even more importantly, when you look at that marketplace, that industry, it's dominated, and I mean dominated, by about 50 companies. So if you're really interested in being in the seafood business, other than maybe being a fisherman that just delivers the goods to the manufacturer or processor, but if you're interested in being in the processing side of that business, that's something that you better take a good look at, because you're going to be bucking 50 very large companies in order to try and get into that business. Identify sources for potential acquisition candidates. So what do? Well, I'll get back to that. So you need to identify the sources, and we'll talk a little bit more as to where those sources are and where we find the potential candidates to acquire. So some of the strengths and resources that you've got to look at is the passion of the buyer to desire and the desire to succeed. Is the buyer, does he or she want to be a passive investor? I mean, that's a lot different. So you ought to look at that up front too. Are you intending to just buy something and this will be your second source of income, and you're going to keep your main life's work going? Or is this something you want to make your life's work, and you're going to get in there with both feet? Or you already have some businesses that you own, and you're just expanding your base. Patience and persistence in the buying process is really necessary. You want to avoid jumping at, just like when you're buying or selling a house, you want to make sure you don't jump at something and end up making a bad decision. From the buyer's standpoint, if they're going to be involved in the business, what's their work ethic? Now, this is a consultant or things that you need to just bring to the front. Sometimes these topics aren't that easy to talk about, but they're necessary if you're going to do a good job for your client who wants to buy a business. How much self-confidence do they have? Are they someone who you feel could be a good entrepreneur? I was never what I consider to be a good entrepreneur candidate. I could work within the confines of a business very well, but I don't think I ever would have done well saying, I'm just going out and hanging out my own shingle. My brother, on the other hand, who is talking about, he and I used to be partners for 16 and a half years in a CPA business. I needed to get a bigger platform for my valuation practice. I went with a firm called Clifton Gunderson, large national firm. He hung out his shingle with 3 other guys, and good for him, and he made a good success of it. So do you have that self-confidence as a buyer to fit into whatever is going to be the result of that acquisition? Personal stability, decisiveness, leadership skills, management skills, all those things. I think the way to get into the discussion with the potential buyer without being offensive is, hey, we need to list all these things for you because in our being able to consult with you and help you find the right fit, we need to know the answers to all these questions. And I think that's probably the best way to get into the situation. So now matching again, continuing, matching the buyer's strengths and resources to those of the target company. So now we're proceeding to say, okay, if we have a target company or a target industry, then as the buyer, how much technical knowledge does the buyer have and professional skills for the business at hand? I worked with a business to sell quite some years ago, and they were tool makers is a real simple way to say it. In fact, the name of the company was Tool, such and such Tool. And these were smart guys. These were engineering guys. And the dad had started the business, but the 4 boys who were all engineers, they came in and started running the company and took it over from the father. But the point is that here's what would happen. Back in the heyday of the Detroit automakers, and these guys were located in Indianapolis, where I'm located, the Detroit guys from the big 3 would come down here, and they would bring a part that would fit on an automobile that they were going to mass produce. And they would say, see this part right here? I need a machine that'll crank out 200 of these an hour. Something like that. I'm just making that up. And these guys would reverse engineer the part and build a machine that would make the part and produce 200 of them an hour. And they'd build a machine, make the machine, and sell the machine to the automaker and ship it up to Detroit. Fascinating business. I helped them sell that business. There was a group of 4 men who bought the business. They had some technical knowledge. They were good businessmen. They had a lot of knowledge in business, but I didn't think even from the beginning that they had enough of the right knowledge base for for the exact situation of that business where they'd have to reverse engineer that part and build a machine to make it. And sure enough, they didn't make it, so to speak. The business eventually, they ended up having to shut down. We sold it at a good price and at an appropriate price, and we did not. We had an attorney that was just really fabulously smart, and he was able to get a very small loan, like a $1,000 loan, with a first preference underneath the banks. And that turned out to be fabulous because when the company went under and we still had seller's debt outstanding, he was able to force the banks to pay off the seller's debt because he'd he'd slid $1,000 worth of debt underneath the banks. Pretty slick move. Anyway, business savvy, does the buyer have enough business savvy, or can the buyer, appropriately hire enough business savvy? But I think really most buyers, if you're going to buy a business, they're going to have some understanding of business. They should have an understanding of basic financial information. I'm sure you all know, because you all have clients that, I used to have clients that wouldn't know which side of the balance sheet to look on for something. And so, it's really important if you're going to buy a business to have an understanding of that financial information. Organizational skills. Do they have the ability to look at this business and say, well, this business has been doing things this way, and I believe there are opportunities there to make this more efficient, and that can be taken into the cost or the synergies or whatever. So there's a lot of these things that have to be looked at. So identifying critical operating characteristics of the target company is important also. Go in there and before you make an offer to buy anything, find out how they operate, what they do, how they do it. The tool company, I don't think that the men that bought that company really had enough understanding of the characteristics of the operations, and that's where they fell down on the thing. And not only that, but there were a lot of personal relationships that they didn't take into account. Obviously, if you'd been building parts for the car companies for 35, 40 years as they had, you've built up some relationships and some trust. And, of course, all that went out the door because these gentlemen that sold it, they were not going to stay on and work in the business and transition it. So, that was part of the reason they failed. Evaluate the adequacies of the buyer's strengths and resources. So that's where you as a consultant can come in, is to say, okay, I need to help you guys figure out what we're doing here, and whether the buyer has the adequate strengths and resources to make this thing a go, and not just jump into something that they're not going to succeed in. So where are the sources of potential acquisitions for the buyer? Well, attorneys are good sources. They often have clients that are for sale, or they know of people who are wanting to sell a business. Banks and other financial institutions are often good sources of potential acquisitions. CPAs and consultants, not only your own CPA or consultant, but others that you may know in the marketplace, or that your CPA may know, put out the word to look for some potential companies to buy with such and such a profile. Insurance agents, real estate agents, certified financial planners, other financial professionals are a source, also can be a source. Merger and acquisition specialists, business brokers I'm talking about here primarily. Now, the business brokers often deal in the much smaller companies, and so if you're in that range of wanting to buy a small company, and that fits you as a buyer with what your needs are, then the business brokers can be good sources of companies to buy. And once again, we'll talk about it, but you need to be careful there on setting up the agreement with the business broker. The SBA and other governmental units can often, lead you in the right direction. Customers and suppliers, the grapevine in the industry, and we'll talk about that when we get to the seller side, is that it can be a blessing to the buyer, but a real nuisance to the seller in a lot of ways. Trade associations are also good sources of where you're going to find potentially a business to buy. And, there's just these people, or this list of people and organizations provides the buyer with a good start as to finding it. But you have to do the things we covered prior to this in these other slides first. In other words, get your information together that lets you have a good handle on exactly the profile company that you want that's going to be best fit for your buyer. So now let's look at the decision from the seller's standpoint to sell a business. We'll keep flipping back and forth between the buyer and the seller, as I mentioned earlier. So in deciding to sell a business, it's more than just a financial decision. More often than not, it's influenced as much or more by personal factors. In other cases, the decision has been made for the seller by outside parties. Regardless of the reason, selling a business is usually a difficult decision. You know, it could be a health situation. It could be a family situation where you don't have anybody that you believe is a good candidate to take over the business within the family, or don't think they can make a go of it, and so you have to be in a situation where you are considering selling the business as the alternative to trying to pass it on to somebody within the family. So there's a lot of factors, and selling it can be, and usually is, a difficult decision. My experience has been that almost every person who sells a business, it's a really painful decision for them, and it's a life change, sometimes a material life change, and people have to deal with the emotions of that too, because that life change is not just selling the business, but moving on to the next stage of your life, so to say, can be a very difficult thing to deal with. So some of the pros and cons of keeping versus selling the business. Again, you, as a consultant, this is where you can help. What's the age of the seller? What's the health of the seller? Again, changes in life priorities or family changes. Could be a divorce situation. There's just unlimited numbers, but it's important to identify all these on behalf of the seller in order to make a successful sale of the business on behalf of your client. Could be that the seller is bored. There are lots of clients I've run into before that bought and sold, a number of businesses, because they buy them, they fix them up, they run them, they make a good profit, and they decide to get out and move on to the next one. It happens. So new opportunities may arise that were unexpected on the part of the seller, and the only way that the seller feels they could take this new opportunity would be to sell the old business. If you own a business that's in a stable but maybe even a declining business, I mean, all these things are going to affect the price, obviously, but you might say to yourself, as a potential seller, I feel I need to move on to another industry. That can be part of the thing that you look at. Recognition of the ownership deficiencies. The business may not be being run very well. So if you're going to help the person sell this business, you need to get a good handle on those deficiencies, if there are such deficiencies, and be able to help the client, make the right kind of sale. And sometimes that means shoring up some of those deficiencies and waiting a year or two to sell the business. In other words, sprucing it up and sprucing the value up to sell it. In other cases, it might be a recognition of the fact that there are opportunities there for a new buyer that a good consultant on the selling side can help boost the price and get a better deal for the seller by actually selling the deficiencies as opportunities for the buyer. Declining product life cycle. That makes a business harder to sell because most buyers are, recognize the fact that there may be that there may be product life cycle issues that come into this. And so what's the right time to sell? I mean, you want to get out before the whole market collapses. I had a client one time who sold word processors. And for those of you old enough to remember, old word processing machines were actually kind of predated the computer age a little bit. They were computers themselves in a lot of ways, but they were standalone machines that they were greater than a typewriter, but less than a full computer, and they did a lot of this processing work. And I had a friend who was actually owned a company in that business, and unfortunately for him, he just didn't have the foresight. And I worked with him, and I said, Danny, I hate to tell you this, but these things that are just coming out now called personal computers, PCs, they're going to replace this. And, he was telling me, oh, there's no way, we have this, and you'll never be able to replace word processing with this. Well, anybody watching this presentation can see that I put this together with PowerPoints on my own out of my personal computer. And so, yes, the business did go out of business. It went out of existence. And so you need to, as representing a seller, you need to note the potential product life cycle issues that you're going to have to deal with in representing the seller. There may be outside influences. The business may be underperforming to the extent that it's had to borrow a lot of money, and now it's in a situation where they're getting a lot of they're getting a lot of pressure from the lenders. It might be that the seller or the providers of materials and things like that may be putting pressure on them, changing what they do. Some years ago, my wife's been in the promotional product business, it's a good business to be in, but it's a really tough business. And some of the outside influences that affected her business was that some of the large companies who would find the products for these people like my wife to buy the products from, to resell them, and this happens in a lot of other businesses, they just decided, well, what do we need you for? So they went out and started getting their own salespeople and just competing with their customers. First of all, it wasn't a real nice way that they handled the thing, not a really great thing to do, but that caused a lot of these smaller people to go out of business or to at least reduce the value of their business. So outside influences can be very difficult. The business may not be making much money. For those of you that are valuation people, which I suspect are a good number of you, if not all of you, on this call today, there's this one type of valuing a business with a seller's discretionary cash flow. Most of the time, those are small businesses, and in a lot of cases, someone's buying or selling a job. And so the money and the profit side of this are big issues, not just for the pricing of it, but just for the selling process itself. It's more difficult to sell one, obviously, that's not making a lot of money than it is to sell one that is. So identifying personal and financial goals in selling the business. Personal goals, when do I sell it? As I mentioned earlier, maybe I need to spruce this business up a little bit, get the value up a little bit, and so maybe I need to tell you that you need to do it 2 years from now. Some people will come to you as a seller and say, I don't want to do this right now, but I know I need to do this in the next 2 to 5 years, something like that. You need to identify what's the best timing of the sale that meets everybody's issues. Continuing involvement with the business. Is the seller going to will the seller continue to be involved with the business? Does the seller want to be involved with the business? Are we going to sell only to a specific type of buyer? Or and what employees need to be retained? So, I had a business that they put on trade shows, like Christmas Hobby and Gift Show was one of them here in Indianapolis. They did a florist trade show. They also did one called the Flower and Patio Show in the spring, and very good business, very lucrative business. it was owned by a couple, a husband and wife, and they had no children, no real close family members. They wanted to sell the business, but it was their child. And so they were in their 70s, well into their 70s, when they finally asked me to help them sell the business. But the point is that they said, we really want to keep this business operated within, close proximity of Indianapolis. In other words, we want local owners if we can find them. So they identified the type of buyer that we could sell to. And interestingly, even though we did have some other interest, some other people interested, including a company from Canada who had a number of these shows, we ended up selling for less money to a company, actually a newly formed company here in Indianapolis, of people that were going to operate these trade shows from Indianapolis instead of from Canada. The sellers gave up a lot of money to do that because they sold at a price that was a lot less than what the Canadian company was offering. But that's what they wanted to do. Again, they had no children. They had been very successful. They had all the money they needed. And so they just said, we don't need the extra money, so this is what we're going to do. So that's the kind of thing that you can look at. Here's a question I've got. I'll stop here and look at this now. Does the target company typically cooperate with your due diligence when doing evaluation of the target? Yes, I would say that they do. A lot of times, and you'll see this, the valuation will have already been done by the selling company. Sometimes it is, sometimes it isn't. On the buyer side, yes, if you're going to buy the company and you want to get your own internal valuation, there is usually a cooperation and due diligence of doing the valuation on the target. I mean, think about it, there has to be, because you've got to get the due diligence done also. And once you get the information for the due diligence, which generally is deeper than you might go for evaluation, you have all the tools that are necessary to get that done. So another thing to look at here is the employees to be retained. Some people are very, very shepherdly and want to make sure that employees have a good deal and are able to be retained when the business is sold. That's easier said than done. And a lot of buyers are going to balk at some of that because they know that they need to have the ability to clean up the messes, so to speak. And some of the messes may be problems that are related to particular employees. So I would say that oftentimes you might want to go to the seller and say to them, listen, you can only go so far in telling the buyer that they have to retain 100% of the employees, 80%, or this list of employees or whatever, because they need to be able to have the flexibility to do what they need to do to make the business successful to them as buyers. So one of the ways to get around that is to just set up some sort of situation where you will bonus out part of the sales proceeds to the employees that you have on board when you sell the business, that at least gives them, what would be, let's say, a decent severance if the buyer decides not to retain them. So identifying personal and financial goals in selling the business. Financial goals, what are the immediate cash needs of the seller? Does the seller need to pay off debt to get out of debt? Does the seller just need enough to be able to buy that great house on the beach that they want in order to retire? Do they really need short-term living expenses even to sell the business? What kind of retirement income are they expecting out of this? Is this what's going to make their retirement? Are they reinvesting into another business? And if so, then that can impact how much you need to get out of the business that you're selling. It's like buying and selling a house. You may have to get X amount of dollars out of the house you're living in and you're selling in order to buy the new house. Well, those are issues you have to consider with a business also. Does the seller have personal guarantees in place, and they need to get X amount of money to make sure that those guarantees are extinguished as part of the sale? And do they need to know that the business image and the general operations are going to be continued in order to give them more, let's say, peace of mind and to make sure that what happens to the business is good for everybody concerned? So sources of potential buyers. We talked about some of the sources already of buyers for sellers, but how do I find the potential buyers? Well, once again, you can do attorneys, CPAs, banks, other lenders, insurance agents, real estate agents, certified financial planners, M&A specialists. Paid advertising is one way to do it too, and you can do that through multiple ways. I mean, you can go all the way from putting an ad in the New York Times to advertising on television. You don't see this often. More likely, it's going to be targeted advertising, where you're in a trade magazine or a trade association or something, and you're actually paying someone to advertise, hey, I got this business that's for sale. Now, a word of caution for the sellers, commissions, and we talked about this a little bit with the business brokers and the investment bankers. You need to involve legal counsel when you're looking at these contracts that you're being asked to enter into to sell your business. You need to check the reputation and the references of the firm that's going to represent you, because that can be a serious issue, that could cause you a lot of grief and a lot of money. If you don't, you could be scammed on a lot of ways on this. So make sure your legal counsel there. I would also say you should also involve your accountant or consultant, business consultant, in helping to check this firm out too. And one of the things you want to be aware of is, in addition to the thing that I've got noted on here, but is to make sure that you don't, and this is true when we start talking about the acquisition or the selling team, is to make sure that no one person has an inordinate amount of influence or control over the process. You need to have as much information and as much advice as you can get. And so you don't want to have a situation where you're giving all the control of the process over to, let's say, a business broker, and your other consultants are not involved. Particularly your legal and financial consultants need to be involved. Also note, beware that some of these firms will force the seller into a boilerplate agreement that resist changing, quote, sacred wording. Well, if they want to represent you, sometimes there's no such thing as sacred wording, and you need to be clear of that on behalf of the seller when it comes up. Also beware of these front-end loads that require you to put up a lot of money in order to have your business sold. It's not as prevalent as it used to be, but there was a company that was running around nationally, and they would say, "Oh, we can sell your business. You just got to pay us X amount of dollars up front, and we'll get going on this, and we'll get everything done." And some firms still do that. But you can be left with a situation where the money has been expended on your behalf, and there's no good buyer that's come forth, or not the right situation. You end up spending the money on this commission, and you get nothing for it, and then you've got to start the process over. So also with these people that want a contract with you in order to help you sell the business, make sure that you clarify expectations and timetables. So that there's no coming back later and saying, hey, a year ago you told me you could sell this business for me in about 90 days, and here we sit. So get some expectations, get some timelines, and follow them. and have some points at which you can, either move the process along somehow on their part or extract yourself from it without any significant amount of financial loss to do that. Be sure to beware of state and federal securities laws, so you should have your legal counsel involved. Here's a problem that you get into. The smaller businesses may have the corner attorney, particularly in some rural areas, but also in some urban areas, that really aren't really versed in this. Now, I realize that big firms cost more, and lawyers with specific skill sets, for example, in selling a business cost more, or buying a business, but they're generally speaking, they're going to be well worth the money and the time, because the state and federal securities laws can be onerous if you don't follow them and you don't know what's going on. Maintain the confidentiality of your information. So once you start the process, make sure you get non-disclosure agreements that are tight from the people that are looking at your business. And this can run the gamut, but I've seen cases where they've potential buyers have just taken advantage of the sellers by using this confidential information to help them buy some other business or even start their own business. It's kind of hard to, avoid that 100%, but that's the kind of thing that can happen. All of a sudden you turn around and, wait a minute, you guys were going to give me an offer last Monday, and they say, well, we've decided to start our own business. They got all your information, all your sources. You need to get some restrictions so they can't approach your customers or your suppliers and things like that. So it's very important to make sure that you maintain your information confidentiality and business confidentiality. From the buyer's perspective, identifying financial and other business resources. So the buyer is going to obviously have to have the money to buy the business. So let's talk a little bit about that. Well, you start with the internal resources. A personal statement of financial condition, preferably that's prepared by an accountant. And that's more of a, look, the buyer should be very open with you in order to make this thing work. But on the other hand, some of the buyers may not really understand what their financial condition is. Maybe they shouldn't even be a buyer at that point, but that should be part of the process. So I think it would help to have a review of that personal financial condition assisted by, let's say, your independent accountant or an independent accountant before you say, I can commit this amount of money. Available assets of the buyer. What are those assets? Do they have trust funds sitting over the side? If they do, can they access the funds? You don't want to be sitting around saying, well, I'm going to buy this business because I'm going to get this money when so and so dies. That's you got to make sure that these funds are available, or that kind of a shortfall can wreck the whole business. For example, I did actually it was a divorce case. I was on the wife's side, but the husband had a trust fund, a very sizable trust fund that he was going to be able to reach. And he was the sole beneficiary of this trust, but in order for him to get the funds from the trust, and he was already in his 60s, he had to wait until his two aunts, who were the life beneficiaries, died. And one was 98 and one was 95, and they were both rolling right along when I did this. I don't know how much longer they lasted, but he'd already waited 30-some years in order to get to these funds, and they weren't there. Other internal resources, family and relatives, that's a tough subject. It's a touchy subject. You've got to advise the buyer look, we got to approach these things. From the standpoint of representing you as a buyer, we have to be sure those funds are there. It's not this whole thing, and I can't tell you how many times I ran across this in my career. It's like client comes to you and says, I want to set up a restaurant. Restaurants always seem to be the targets for these things. I want to buy a restaurant because my grandmother had the best spaghetti sauce recipe you've ever seen, and people just rave about it. And I've had people come to me and say, if you ever set up a restaurant, I want to invest in it because it's going to be a huge success with Grandma's spaghetti sauce. And I would always tell them, okay, here's what you do. Before we go to step number 2, I want you to call every one of those people that you think are the targets that would help invest in a restaurant and ask them if they'll write a check. And that usually ended the discussion on buying a restaurant or starting a restaurant, and with that as the resource. So be careful on this family and relatives. You better make sure that it is a couple things. You better make sure, first of all, it's a valid resource to use as funds to buy the company with. And secondly, what's the family and relatives dynamic between them and the buyer, so that we don't get into a situation where they're going to be calling every week and saying, what were the sales this week, and how are things going, and what's the profits and all this. You got to be really careful when you use that as a source. But it can happen, and it can be that way. I knew a family where the father of the family had invented I don't want to give away too much identity. All the people are all deceased now, but the father had come up with a stove, a cooking stove for a kitchen. It was a unique product, and he expanded it into other appliances, and he was very successful, had lots of money, very Christian-oriented man. So he said to his 3 daughters, I'm going to give each of you X amount of money. And it was 7 figures for each one of them. And the rest of my fortune I'm going to leave to the church. And so just wanted you to know now, this is what you're going to get. So, okay, so there was a case where the family money was there, it was in a trust, it was acquirable. And so each of the 3 children ended up buying a business, either for them to operate or for their husbands to operate, and use some of that money to fund it. The interesting point was the father still was keeping his thumb on the pulse of the situations, even though he'd given them the money to be theirs. So outside sources, from the perspective of buyer, private individuals, possible, there's angels out there. You have to identify them. A lot of cities have capitalist clubs or venture capital clubs, and they invite people who want to buy a business and need funding for the business, either to start it or to buy an existing business, to come and make a presentation to them, and they'll consider whether they're going to put some money in it, either 1 or 2. It's kind of like the Shark TV show on a smaller scale. So there are private individuals out there, but once again, you have to understand as a buyer that you're going to give away control. You're going to give away the fact that you're going to have oversight that you may not be comfortable with, and you're going to have to give up a piece of the business, and maybe a bigger piece than you want to. But it's a possibility. Venture capitalists, the same thing. Those are individual firms that are set up to operate as investors in these businesses. Most of the time they require a minimum size business, so they're in a little bit bigger size. Once again, you're going to give up control issues, you're going to give oversight issues, and you're going to give away a lot of the business, sometimes even control. Governmental agencies like the SBA might be sources of funding for a business investment. private-public entities. There are some states who have helped, put funds together that really have the purpose to act kind of like a venture capitalist fund, but the government's funding a lot of the source money for it and their possibilities. Investment bankers are similar to venture capitalists. The investment bankers are more on the line of making investments that they can get in and out of and structure more like a high-price loan, let's say, than the venture capitalists who may actually go in there with the idea of, again, having a big chunk of the business and turning it over quickly. Other businesses might be possibilities from a buyer's perspective. And I've seen this happen. If the seller is a particularly important customer of, let's say, a supplier of materials or a supplier of whatever services, whatever it is, that the supplier or that other business may be interested in maintaining the existence of their customer. And so they may be willing to finance part of the sale on behalf of a new buyer in order to just keep that person in business. Okay, we'll be moving along here so we keep on target. So assembling the acquisition team, and this is one of the things that I mentioned, members from the buyer's management team. So this is the buyer's side. Legal counsel, I would say, should always be a member of that team. Independent accountants, I think, always should be a member of that team. Or if you don't have an independent accountant relationship, then you may want to set one up, or you want to maybe have a consultant, a business consultant that's close to that. Other potential members, business valuation expert, equipment, real estate appraiser, engineers, particularly on this equipment, real estate appraiser, that's needed if you've got a heavily equipment, real estate-based business. Engineers, in some cases, are helpful to the situation. Financing experts also to, again, help find the financing and structure the financing. And specialists. So I've done a lot of valuation work on limestone quarries. And you need a geologist in a limestone quarry in order to figure out how much reserves are there and what the value of those reserves is. It's unfortunately a lot more complex than that, but that's just an example. So you need to establish specific goals and timetables. Buying a business takes time, and the entire process takes 3 to 6 months to complete or more, and what appears to be a relatively simple transaction can often be complex. So establishing specific goals and timetables can accelerate the process and reduce the number and severity of the disappointments along the way. Again, from the buyer's perspective, the goal-time matrix. Using a goal-time matrix is a simple yet effective way to organize thoughts and prioritize the process. The matrix comprises a vertical listing of all tasks and duties to be performed, along with a horizontal listing of the time factors. It's important to list the tasks and duties in the proper order so they're not duplicated or performed out of order. Performing a due diligence review. Again, from the buyer's perspective, review the current and historical financial data, secure credit references, interview management, employees, vendors, customers, perform an operational walkthrough, review internal control structures and management information systems, consider an acquisition audit, review or agreed upon procedures engagement, and review all legal matters. To summarize this whole slide, you need to do a deep clean on this financial information and on your due diligence. And I would strongly urge you to look at some review, not necessarily by an accountant, but you need to do some review in order to make sure that you get sufficient information to make you feel comfortable that you're going to buy this, whatever you're going to buy works out. Okay. Give me a second here. Do the next one. Okay. So business acquisition checklist. You can get these. They're actually the book that I talked about that these materials come from. We have a business acquisition checklist in there. I would suggest you rely on your team to help you do this type of investigation. Here's another question I've got is, what have you observed over the years between valuation results and actual negotiated transaction prices? Interesting question. We'll get to some of the valuation issues, but the answer to that question is it's all over the map, because you got to remember one thing. Fair market value is not transactional value. So interestingly, I do a lot of speaking on this calculations that are under the BV standards for the AICPA, which has caused a lot of ruckus. But a great use of calculations is to come up with a range that you think the business would actually sell for. That's a whole lot different than doing a garden variety fair market value valuation. If you do that, then, and you do it in a range of values, which I highly recommend, then I think you will get a pretty good answer within that range. Okay, so you should have a business acquisition checklist. From the seller's perspective, getting the business ready for sale. Again, you may want to take a year or two and maximize your profits, bolster your credit rating, make no major investments because you're getting ready to sell it. Improve the cosmetics of the business, and consider having an audit performed if it hasn't already been done. So you need to gather up the information early, put it into a package, have it ready for the buyer to review. Copies should be made in order to make it more convenient for the buyers, along with confidentiality and non-disclosure agreements, which we talked about to some extent. Communicating with management, employees, vendors. The manner in which you disclose the intention to sell is made, and the timing of the disclosure can have an important impact. So, the people that it's most important to are the employees. And so you got to be very careful, because once you start talking to people about this whole process, the word's going to get out. It's going to get out fast. And so you need to make sure that you take care of that issue. And but you may need to talk to suppliers, and you may need to maybe even to help you find a buyer, or just to say, hey, I'm going to have some people coming in here to buy this. I need to make sure that we can continue these arrangements and all that kind of stuff. So there's good reasons to do that. From the seller's point of view, again, assembling the divestiture team, members of the seller's management team include legal counsel, independent accountants, business brokers, if you are using one, family members, friends, business associates, or possibilities. Beware of giving these members too much authority, and I've already talked about this. No one person on this team should have too much authority, and that's especially true if you have any family members, friends, or business associates on the team. Business associates in particular, has been my experience, can just cause all sorts of havoc because they tend to be highly control-type people themselves, and they want to insert themselves into the process more than they really should be. Non-disclosure agreements we've talked about. Make sure that you have those signed by everybody. Make sure that there's a contract between a seller and a third party. Most agreements require all documents to be returned at the seller's request and prohibit parties from copying them. These are prohibitions, and a lot of times the only way you can enforce that is after the fact, in a lawsuit. But you should have them in there anyway. Identifying the assets not for sale. some assets do not add value to the business. Could be artwork, furniture, vehicles, insurance policies, cash accounts, vacation homes, airplanes. It goes on and on. And so you need to identify all those assets and make sure that the buyers know that they're not for sale, and then you got to figure a way to get them out of the business when you go to the structure. So unlike independent fair market value, as I've said, the objective of the buyer or the seller is to establish a price that they can either afford to pay, buyer, or afford to accept, seller. And that's unlikely to be the same price between the two, and so that's where the negotiation comes in, is you need to be able to be a good negotiator and get the best price for either the buyer or the seller, whichever side you are working for. Price relates to the total economic benefit. So it will include covenants not to compete, employment contracts for equity owners, consulting arrangements, and the acquisition of unwanted assets by the buyer. So on this issue of using a valuation expert, select a qualified evaluation expert with one of the accreditations that we all see there and don't really need to know the difference. And you may need the assistance of a real estate, machinery, equipment, or somebody with specialized knowledge, as we've said. Independent valuation pros and cons. While the buyer is interested in the investment value, that is the return on the buyer's investment, fair market value is also important in providing a guidepost for both the buyer and the seller. But once again, I caution you, as I answer that question, that the best objective in my experience has been either if you're looking on the buyer side or the sellers. Now, the buyer side, they're going to take into account the synergies they might expect and other things in order to determine what's a fair price on their side. The seller should have a range of knowing what the range of potential transactions are and the proceeds. So the pros to the buyer of obtaining an independent valuation include assess the credibility of the buyer's determination of an investment value. Sometimes they don't know what the business is worth. They think they know, and it's good to have, for their purpose, a valuation done so they can say, look, here's what it's really worth. To help to determine the nature and the structure of the buyer's offer to the seller, provide a basis for determining the bargaining zone. In other words, that's that range where the buyer's willing to buy and the seller's willing to sell. Help the buyer convince the seller of the negotiating price range, obtain financing, provide documentation support in allocating the purchase price to various assets acquired. The cons to the buyer of this valuation is the cost may not be justified, particularly in very small acquisitions, and that's where this calculation can come in to effect. Engaging an independent valuator to determine an investment value is of questionable value to the buyer, since the investment value is really the buyer. The investment to the investor is in the best position to develop the assumptions necessary. So a properly assembled acquisition team should be able to determine an investment value better than an independent valuation expert, because they need to know those other things. And that's, again, where a calculated value could be a better answer if you're going to try and work for the buyer's side to say what's a good value for us to pay for this. It's almost a return on investment, an ROI type calculation instead of a valuation. While a fair market valuation might have benefits in allocating the purchase price, it does not provide an investment value, generally speaking, unless that's your specific task. You can use the valuation expert as a consultant. A lot of times, the valuation expert may have substantial tax experience. They may have negotiating experience, so they can be a valuable part of the team, not just for valuing the business, but for overall. Financial information, how much and what information is needed, is ultimately up to the buyer. The important factor is to obtain sufficient credible information. Non-financial information includes things like roadmap to tell the buyer how the financial results were attained in the past and can be attained in the future. The easiest way to obtain this information is to use a questionnaire to be completed by the seller. Information on the economy, the industry, and comparable companies, really important. You've got to know what's in the industry. And you can't just buy this company in a vacuum without knowing what's in the industry and what the industry is about. And so, you know, I would encourage you to make sure that that happens in all of these cases. As part of the price negotiations, the buyer should attempt to solicit an offer to sell from the seller. So even if a formal offer is not obtained, it might be possible to identify a price range or even a single price which the seller expects to receive for the business. Getting the seller to disclose an acceptable range can require considerable tact and negotiating skill. You know, everybody's trying to play poker with the price. The buyer's trying to play poker, don't want to leave money on the table. The seller's trying to play poker. They don't want to pay too much for the business. So it's a real tightrope to make sure that gets done. Determining a purchase price. From the buyer's perspective, you need to prepare projections and or forecasts. The most important reason for projections or forecasts is to determine the ability of the business to pay for itself at a particular price. You can refer to historical performance, develop valid operating assumptions going forward, adjust for owner compensation perks, and determine valid financing assumptions. So you're really starting to build this thing up from the ground floor if you're the buyer to how do you determine that price. So gathering all information, then the price needs to be determined by reference to the historical performance, the buyer's ability to obtain financing, and the buyer's ability to pay the purchase price out of future earnings, and more importantly, out of cash flow. Planning point, as a negotiating strategy, the buyer's initial offer or counter offer should be below or at the low end of the range the buyer is ultimately willing to pay. Basic concept there. That'll leave room for parties to compromise. The pros to the seller obtaining an independent valuation include, the seller now we're shifting to obtaining an independent valuation include assessing the credibility of the seller's own and sometimes biased determination of fair market value. An independent value determined under both an income capitalization method and a DCF is a good guidepost for determining a negotiating price range. Independent valuation based on DCF can help the seller convince the buyer of an appropriate negotiating price range. And a fair market value independent valuation might be required by a bank, venture capitalist, or other lender, including, for example, the SBA, to put all that stuff together. Okay. On just a second here. Okay. So the cons are that the cost, again, might outweigh the benefits to the seller. The seller might be better served with consultation from a valuator or other members of the divestiture team than an independent valuation. The seller is more in need of an indication of value to help he or she determine the price range than an independent valuation. Obtaining a calculated value instead of a full valuation, we've already talked about that. Calculations, I think, are extremely valuable tools for either the buyer or the seller in this whole process of buying and selling a business. This is just made to order. Calculations are, in my opinion, for this type of a situation. Using the valuation expert as a consultant, as in the case of the buyer, the valuation analyst may have lots of experience in tax, negotiating, purchase and sales. Now, such a person cannot be both independent and a consultant of the seller. So, again, from the standpoint of your standards, you're not really independent in this case, and that's another reason that calculation is a good indication. If you are independent, then you really aren't going to be able to help out in these other areas. again, from the seller's perspective, put the financial information together, put the non-financial information together, help the buyer by putting some of the information on the economy, the industry, comparable companies, and soliciting an offer to buy from potential buyers. Prepare projections and forecasts, refer to historical assumptions, develop valid operations assumptions, and adjust for the owner's compensation expenses, related party transactions, etc. One of the questions, have you done valuations for the SBA? They want an opinion, but usually the business involved are so small, they want to pay for a full valuation. When I was with Clifton Gunderson, we stayed out of the business for exactly the things that you mentioned in the question. They don't want to pay for it, but they want an opinion, and a lot of times they want it so that they're able to determine the liability, or they're able to come back on the valuator. You don't want to be in that position where you have exposure. So if we were going to do one for bank or SBA, we would get a letter from the bank saying they would not use the valuation to determine the purchase price, or to determine the loan amount. Most of them didn't want to do that, so we just got out of the business. Another question, what do you use to assess the market structure besides first research? Okay, IBIS and BizMiner, I'll get to that. Okay, so determining the range, after going through the process, describes the sellers in a position to make an informed decision on determining an acceptable price range for the business, such as proper preparation, keeps the seller from an unrealistically high expectation of the price, can also avoid undervaluing the business. An uninformed seller might set a price too low, resulting in the business not being sold for a bargain. There's simply no substitute for knowledge, even when it's one's own business. A smart seller will make good use of the divestiture team to help determine the reasonable price. And Andy, I know you need to do the codes at this point.
Yes, thanks, Jim. I need to remind our listeners of the CE codes they'll need for the survey to receive CPE credit. The codes for today's webinar are 8579, 5213, and 5471. Again, those codes are 8579, 5213, 5471. Use these codes for the survey to take at the end of the program. The link is on your registration email. It's also on the reading page for today's webinar. It'll also get pushed to you after the webinar as well. Also, as a reminder, for any questions, please use the chat feature on the left side of your screen. Okay, thanks very much.
Sure.
Back to you, Jim.
Okay, let's keep moving along here. So how do we structure the purchase price or the sale? That can be as much of the part of the negotiation as is the price. So structuring from the buyer's perspective, buying stock, the advantages to that are the entity and its attributes continue uninterrupted. All contracts, rights, assets, patents, copyrights, trademarks remain intact post-purchase unless they have provisions in them that deal with changes in control that would negate the contracts. The buyer needs to know if those are there. The buyer takes a high tax basis in the stock equal to the amount paid for the stock. Advantages, again, of a stock purchase: if an individual group or a group of individuals acquires the stock, there ordinarily are no accounting considerations, since the company will continue its accounting as though no transaction has occurred. If the purchase is a corporation, acquisition also allows the use of a tax-free transaction in the form of a statutory merger or a stock-for-stock known as a B reorganization transaction. Just things to note. Further on advantages. If the business acquired as a small business, then there may be favorable tax treatment on the subsequent sale thereof. I just read an article where a lot of businesses are not familiar with these provisions and are not excluding the gain that they might be able to exclude. So it is something to keep in mind. If the purchaser is a corporation, acquisition of stock can provide a liability shield to the buyer. Disadvantage of a stock purchase, purchaser does not obtain a step up in tax basis of the assets of the acquired company unless there's a Code Section 338 election or unless the buying entity, well, there isn't if you're buying stock and it's a corporation. Because there are no immediate tax benefits to the purchase, the buyer must pay for the purchase with after-tax dollars. When the stock is purchased by an individual, the financing has to be structured outside the corporate shell. There are severe restrictions on the use of net operating loss carryforwards, and with the new tax law, they're just extremely difficult to get benefit out of. So don't place too much reliance on being able to use those. Get help in determining whether you can and how. Some of the disadvantages of a stock purchase: existing contractual arrangements continue in force. So there may be some you don't want to continue in force, and there may be real, purchase supply contracts and things like that, all kinds of contracts, employee contracts that you may not want. Unwanted assets might be included with the company, and if you acquire stock, it's more difficult for both the buyer and the seller to figure out how to dispose of those assets, particularly without including a lot of tax gain. Since the corporate structure does not change on the purchase of stock, all liabilities and contingent liabilities carry over to the new owners. This includes such items as product liability, changes resulting from income tax audits, and warranty liability. So, that's something it's like flypaper. You just can't get rid of it if you're buying a stock only. Advantages of an asset purchase: tax basis of the assets purchased are equal to their fair market value, which usually means a step up in the basis. The purchase is paid for in pre-tax, not after-tax dollars. This can lower the net after-tax costs. The buyer can choose its own entity form. The buyer can acquire only wanted assets and assume only agreed-upon liabilities. The buyer will not be subject to contracts and agreements which might be in existence if the acquired company, the buyer has the flexibility of determining the structure of any equity and debt financing. Contingent liabilities of the acquired company will generally not carry forward to the buyer. That's generally. Environmental liabilities, for example, almost always carry through and pierce the corporate veil, so be careful of that. Disadvantages: in an asset purchase, the buyer may not be able to adopt favorable tax accounting methods. The buyer may wish to transfer contract rights, patents, copyrights, trademarks, etc. In an asset purchase, these rights must be separately purchased or bargained for, where in a stock acquisition, they'd remain with the entity. Although a tax-free approach could be used in an asset purchase, this would result in the loss of stepped-up basis and limit the flexibility of other methods of tax-free acquisitions. If the assets are acquired in a bargain purchase, the buyer could have adverse tax consequences, that is, having to recognize taxable income in the year per purchase. Some financing considerations from the buyer's perspective: given that virtually all sophisticated lenders require adequate collateral, the buyer should be prepared to pledge not only the assets of the business, but also personal assets, including those owned with or by the spouses, including personal residences in some cases. The assets of the business acquired will certainly be the primary collateral. Where the business has a high degree of intangible value, lenders might seek additional collateral from personal assets. Another problem arises when the primary buyer uses either seller financing or financing from a private third party, but still have some bank debt. And I talked about the fact that if you're doing seller financing, this will be on the seller side, so I won't go there right now. They're going to require direct collateral, the bankers are, and so it's unlikely the buyer will be able to obtain bank financing, since the bank will want a first position on collateral. So if the seller says, we want collateral for our debt financing, seller's debt financing, you're going to have this back and forth between the bank and the seller as to who gets the collateral. Frankly, if the seller gets the collateral, the bank's not going to make the loan. The buyer might also need to seek mezzanine financing and that's that in-between financing, in-between debt and equity, and that means they're going to give up some equity and maybe even control. Financing consideration, structuring financing, it's important to develop a coordinated structure with the acquisition team. Slight change in the structure can cause major accounting or tax problems. That emphasizes why the team approach is so important. Dealing with minority equity holders, the buyer will have fewer difficulties with this group than the seller, since it's normally the seller's responsibility to reach an agreement with minority shareholders. However, you got to be aware of these state laws on selling a minority interest in a business sale. They may be able to sue for a fair price if they don't believe that they got a fair price. Selling the stock, advantages of the stock sale. This is from the seller's perspective now. The seller will realize some capital gain instead of, let's say, ordinary income in a lot of cases. A stock sale eliminates the seller's need to liquidate or otherwise dispose of the corporate entity after the sale. Stock sale provides more possibilities for tax-deferred transaction, and that's most attractive if the buyer is publicly held. The seller does not have to deal with unwanted assets in a stock sale, maybe. In a lot of cases, if you're selling stock, the buyer's going to say, get rid of these assets anyway before we buy the stock, because we're not going to buy it that way. The seller has to provide additional warranties and guarantees in a stock sale because of the potential liabilities that are there, big exposure possibly. A lot of times you're going to have to set money aside too in a contingent payout fund to cover any of these potential warranties and guarantees. If the seller is financing the sale, stock sale complicates the ability to collateralize financing because you can't get to the assets. If the seller wishes to retain some assets or continue other lines of business, stock sale complicates the ability to extract the wanted assets. If the seller has significant NOLs, we've already talked about that, that's a problem. Advantages of an asset sale, because the corporate attributes do not carry over to the buyer in an asset sale, the seller is not required to offer as many warranties or guarantees. If the seller is an S corporation without a built-in gains taint, an asset sale provides more flexibility to the buyer and no negative consequences to the seller. If the seller wishes to retain assets or other lines of business, the asset sale provides more flexibility. In an asset sale, the seller can more easily retain intangible assets such as patents, copyrights, trademarks that it chooses not to sell or wishes to retain on a royalty basis. An asset sale provides maximum flexibility in the structuring to the buyer. This allows the buyer to more easily buy the company. Disadvantages of an asset sale: if the seller is a C Corp or an S Corp with a built-in gains taint, selling assets can result in double taxation and a high effective tax rate. Although a tax-deferred transaction can be accomplished in an asset sale, the seller is still left with the inability to get the stock acquired tax-deferred out of the selling corporation. Tremendous problem. In a stock sale, the buyer might be willing to take some assets which are unwanted by the seller in order to make the deal. While the same could be done in an asset sale, it's probably logistically easier to deal with in a stock sale. The seller may be unable to transfer certain contracts, licensing agreements to the buyer in an asset sale, which would automatically transfer in a stock sale. Where the seller financing is provided, it's important for the seller to secure the debt if at all possible. It's unlikely the seller will be able to obtain a first collateral position on assets sold, where traditional financing is also part of the transaction. The seller should seek personal guarantees from each buyer. Sometimes you can get them, sometimes that's a deal breaker. The buyers may not have sufficient personal assets to cover the debt, so the seller is going to have to determine whether to take the sale offer and accept inadequate collateral or reject the offer. So it's kind of, the seller needs to say, okay, the seller financing is a what if type of situation. It's a tail. So if I never get $1 of the seller financing, am I still okay? Did I still do okay on the sale? I'm not a big fan of seller financing, but depending on the type of business, it often can be something that has to be dealt with. Consulting agreements should not be part of the consideration, but should be in addition to the sale price. This protects the seller from not only the disability problem, but from any disagreements with the buyer related to performance under the contract. Minority equity holders, we've already talked about the fact that minority shareholders cannot force, majority shareholders cannot force minority shareholders to sell their interest, and a buyer will not normally want to deal with the problems of minority shareholders and will insist that the seller deliver 100% of the stock or assets of the business. We'll go on from that. So negotiating and closing the deal, buyer wins, seller wins, win-win. The ultimate goal of all negotiations should be to reach a win-win. Many believe such a result is difficult, if not impossible. However, patience, confidence, and mutual trust, that can be attained, and I've seen that in a number of cases. Buyer wins, seller loses. A win-lose may sound like the right idea, but it often results in future trouble. Sellers who realize eventually that they have not been treated fairly can cause trouble for the new owners in the long run. If the buyer loses, the seller may only win temporarily if the business fails because the price was too high. It's not uncommon in a lose-win situations for the seller to get the business back from the buyer when it fails. That's not what you want to happen. Often the condition of the business is beyond repair at this point, and the transaction can quickly turn into a lose-lose. Lose-lose is where the buyer and the seller cannot reach a satisfactory agreement. Lose-lose result is not only the worst result because neither party has been directly damaged by the outcome, but it does involve lost opportunity costs for both parties. Real leverage is a situation in which one party has an actual advantage over the other. That might include time, money, stature, prestige, other similar advantages that are real and can't be denied. The party with the greatest amount of leverage, real leverage, need not rely as heavily on the skillful use of perceived leverage, whereas the party with a lesser degree of real leverage must be skillful in applying perceived leverage. Perceived leverage is not a given. It's developed by the party having a lesser degree of real leverage. It may include location, atmosphere, persuasion, wit, charm, and sales techniques. And when I say location of the negotiations. In situations where the level of real leverage is fairly equal, person or persons who can best employ perceived leverage skill will generally be successful. Artificial intelligence and technology are accelerating with great rapidity. It needs to be taken into account in looking at both the buyer's side and the seller side. I would say more importantly on the buyer side, but the seller side needs to be aware of it because it impacts the value of the business. So seek out a member of your team or an independent artificial intelligence consultant to assist in determining the impact. Probably a good idea to determine the industry or service area you want to be in relation to the impact of artificial intelligence and technology. There was a survey done recently by McKinsey & Company, the big consulting firm, that indicated that the highest industry for loss of jobs, go back to my old restaurants again, is going to be the food industry from AI, from artificial intelligence. That's where most of the jobs are going to be lost. Now, does that impact the value? Well, here's a way to look at that. You say, well, my labor costs are down, but if I'm buying a business in that food industry area and artificial intelligence has arrived or is going to arrive, it seems to me you're going to have a large investment in equipment, i.e. robots or robotic software or whatever, up front, and you need to be aware of that fact because that's going to take the equity up front. So your long term is if you're going to save money, But the short term is you're going to have the capital to put out the money to finance the equipment. Just something to look out for. You know what? I don't know what happened. Why I don't recall. Okay, let's go back to this other question. Okay, what do you use to assess the market structures besides First Research, IBIS, and BizFinder? I use IBIS and a lot, and I like it, and I think those are good sources. Other sources include trade associations, where the trade association can be very helpful in determining sometimes they have their own surveys of the industry, or they have an industry consultant as part of the trade association or somebody they work with that they can refer you to. So I always like to go to the source as much as I can. But IBIS World does a good job of this stuff. But in addition to that, I would always go to the trade association and say, what can you help us with on this industry stuff? Another question is, how do you distinguish between the portion of value or price that assumes the buyer's assimilation to legacy relationship versus consulting fees that might be paid to the seller to hold hands for a while? That's not the easiest thing in the world to do, but here's what I would say on that. As I said in the slides, the best option here is to have the sale or the purchase determined and then deal with the consulting issues, so that theoretically at least what's happened there is that the sale price includes just the sale price. Now, if I need consulting, and I haven't already included that in the sale transaction, then I should pay on a pay-as-you-go basis. But if I'm the seller, I don't want too much in these consulting fees because, for one thing, I may not want to do them. For another thing, it might be difficult to make sure that I'm able to earn this stuff. And again, if I'm trying to sell my business and retire, I don't want to have to put X number of hours and do X amount of things. So it's tricky. You do have to work between the two, but it also takes the ability of the buyer to know what involvement is going to be done by the seller and what involvement is needed from the seller. So to the extent that the consulting is needed, then the value of the consulting goes up. Maybe the value of the business goes down a little bit, maybe not. But from the buyer's standpoint, that's all part of the investment that the buyer is going to have. When you do evaluation for the seller, do they typically feel it's too low? How do you convince them that your value is in the ballpark? That's just part of what you have to do a lot when you do valuations for people and it's their business. And what it is you need to just sit down with them and show them the assumptions and show them why you believe that the business is worth only what is in the range that you've come up with and why. I mean, here's the funny thing. Here's a good way to start that thought process. Almost every person that you talk about their business, where they founded it and they're operating the business, what's the first thing they're going to tell you? The first thing they're going to tell you is, I mean so much to this business, it's so important that it couldn't exist without me. Well, right there, they don't realize it, but they've just chopped their head off in terms of, selling price. If they aren't truly the business, it's going to be worth less. I mean, that's just one example of how to do it. But you need to just sit down and go through the valuation process with the seller and explain how you came up with your values. And when I'm doing an actual transaction, I do my best to stay with a range of values and not a point value, because you could end up with something higher or lower than a point value. You're almost always going to. That's part of the fact that, again, fair market value is a range. It's not a point. But even given that you're looking at an actual selling price, that's the way you handle it, is you do a range of values and you sit down and explain the process and you talk with them. You ask them questions. When they answer the questions, you can tell them, okay, well, this is why this, either impacts the value up or down based on what you just said. Last question here is industry sources for targets outside the U.S. Industry sources, I believe IBIS World does some on an international process. And whatever country you're going to, you need to do research within that particular country or countries if they do multiple operations to find out from other contacts you may have, like if you have contacts with accounting firms or especially, or other consultants or other valuation people in those countries to give you an indication of where can I go to find the particular industry situation for this type of business in this type of country. That's, I think, the best advice I can give you on that. So I want to thank you all. We're just about right on time for your attention today, and I'll flip it back over to Andy at this point.
Terrific. Thanks very much, Jim, for a very fine and information-packed webinar. And I want to thank all of our listeners for attending. As a reminder, to receive your CPE credit, you must complete and submit a brief survey on this webinar and include the 3 codes, which are 8579, 5213, and 5471. A link to the survey is in your registration email. It's also on the reading page for today's webinar, and also it gets pushed out to you after the webinar as well. The survey will be active for 5 days, and you must complete it before we can process your certificate. After 5 business days, we will process all surveys and send CPE certificates via email. You can find more information on future BVR webinars at bvresources.com/training. Our next program will be next week, Thursday, July 25th. We'll be talking about using asset attrition to determine useful life. That's next Thursday, July 25th. Hope to see you then. Again, thank you all for listening. Have a great rest of the day, and you may now disconnect. Thank you very much.